This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Blair Hull. He's an American businessman, trader, investor, politician, and has helped a great many people across his charities. I first became aware of Blair through his New Market Wizards interview and Jack Schwager's classic book. One of the most fantastic stories, for Blair truly did start in blackjack, in card counting, making a stake, and then moving on to trading. And even to this day, blackjack is still core. The lessons, the experiences that he had early on, you can see to current day. Our conversation today goes historical and brings things to current day. Current day being the current strategy that Blair has developed. I hope you enjoy this conversation with Blair Hull. Let me first say congratulations. I don't think there's too many people on this planet, and maybe you don't think it's that big of a deal now, but I don't think there's too many people on this planet that can say that they ran for political office and over 100,000 people voted for them. That's still a big number.
I had a few people that voted for me, that's true. Well, I did lead in the polls with about 3 weeks to go and had a slight problem, but that's life.
Yeah.
And you don't regret in life what you did do. It's mostly you regret what you didn't do. And so I don't regret that.
Yeah, I ran for political office when I was 21 in a small town outside of Washington, D.C., about 15 miles outside. And I ran against a guy who was 72. And it was quite the experience. So I think if we had lots of time, we could probably, even though yours is on a different level, there's still a certain understanding that happens when you put yourself out there like that. It changes you. Changes you for sure. Hey, let me ask the big question, though. Still to this day, after all the success that you've had, do you still look back fondly and just say all those lessons from many years ago that started with blackjack, that finding an edge, that's still your heart and your passion, and it all began there?
It's very simple. You've got to get an advantage and you got to stay in the game. You have to understand those both very well in order to be successful. So blackjack is the heart of my strategy.
Would you mind going back in time just a little bit to lay the foundation for the audience? I mean, I want everyone to go read the New Market Wizards, and there's plenty of things they can go check out about you, but I think it might be helpful just to even lay out some of that early experience that you had making it to the casinos in Nevada originally.
Well, actually, my brother-in-law was playing blackjack, and he told me he went up to Tahoe, and he made enough money to pay for his vacation almost every time. And I said, he was an accountant. And I said, well, if that were really true, you wouldn't be an accountant. You'd be doing something else. And so he didn't take it very seriously. I took it very seriously and studied and read everything I could and ended up playing for 5 years. With that, took the $25,000 that I made playing blackjack, and I went to the Pacific Stock Exchange.
You make it sound very simple, but there's a lot of work involved there.
Well, it's a difficult game. It's a very risky game. You only win 2 out of 3 times when you're on a weekend. Every weekend you go up, you're only going to win 2 out of 3 times. And so to stick through all the losses that occur and keep the faith that you still do have an advantage is very important. And then stick to your plan. As to lose half your money, you've got to bet half as much. And so it's difficult to keep your emotions out of the game, too. And we take that into trading also. I believe you have to be systematic and disciplined. And so many times we get fearful at the wrong times, and we get greedy at the wrong times, and we have to stick to a specific plan.
You bring up the systematic aspect, which is something we're going to talk about today. But if I was to go back in time at the blackjack tables, how did you first make the jump to say to yourself, I want this to be a system. I want this to be systematic. I want to get rid of, even though you obviously, lots of people have rules, but there's a difference between having rules and making it a religious, systematic experience that you don't deviate from.
One thing that helps you, if you don't have very much money and you can't afford to lose your bankroll, and I usually say that in order to play blackjack, you've got to be very hungry. You have to have. It doesn't take a lot of brain power. It takes more discipline. If you passed high school algebra, you got a C in high school algebra. You have enough brain power to play blackjack. But it's the discipline. It's the desire and the discipline. One, you've got to be poor enough that you actually need the money, or at least driven enough that you want to be able to do a little better for your family, and then you've got to be. You just got to be disciplined. It's hard for me to describe what it takes. You'd think that if you could beat the casinos like that, everybody'd be lined up. But there are very few people that will actually go and learn the basic strategy perfectly, and then do all the drills. You really have to do exercises in blackjack. It's like your golf game. You got to go over and hit so many putts, and you got to be able to count the cards in a certain amount of time, and every time when you go up again, you have to go through these drills in order to be able to be sharp enough and disciplined enough to win.
I had a guy on my podcast a few years back. His name is Mike Aponte. He was the team leader for the MIT team. So I'm sure you guys would have a great conversation sitting down. Hey, going back in time though, also too, when you were first starting out, Beat the Dealer, would you be sitting here talking today if it wasn't for picking up Beat the Dealer? Or would you have kind of figured out a way into that world without that book?
Well, I actually had discovered trend following before I did this. I actually had bought potato futures in punch cards in 1969, I believe. I was using the IBM 1130 at Santa Clara University. And so I did have a trend following system. But it was sort of interesting. The trend following system really gave you an edge, but you had to stay in the game. But the problem was you didn't get many bets. You didn't get many. So I actually, not having very much money, actually deserted trend following earlier and then went to blackjack, where I got lots of different transactions and different wagers so I could get into the long run sooner.
Well, it's interesting you bring up trend following, but so many of the basics that even though your trading strategies in the 70s and 80s before you sold to Goldman Sachs, those strategies would be quite different than trend following. But the heart of the matter, your edge, your money management, the discipline, sticking with things religiously, that was all very similar.
It's all similar. It's all the same game. Whether you do 10 trades or 1,000 trades a day, or whether you do one trade every 6 months. And that's why my recent project, where I've gone into trying to beat the S&P 500, is a little more difficult, because you don't get as many trades, but you've got to still believe in the system, and you got to stay with it.
Let's open that up. So the white paper that you have out, is that available for everybody? That's available for everybody, yeah, because you have the link you sent me to.
Yes, it is. You go on to SSRN, Social Science Research Network, and I think you search under Blair Hull. You can get it that way, and another way you can get it is going to hullinvest.com, and there's a link on that to get to the white paper. So it's I'm very transparent about what this strategy is, and hopefully people will take advantage of it, and anybody can use it. In fact, we have a section in the paper on the website that says how to replicate the results of the paper.
Well, let's just name it too: A Practitioner's Defense of Return Predictability. Which, of course, for someone who's written some trend following books, and in trend following, the word prediction is usually disavowed. But you're coming at this from a different perspective. Talk about the connection, because you do talk about this, the connection between the drivers or the indicators that you might see in a blackjack strategy and the number of those, it could be 15 to 20, and how you have come to this trading strategy with the S&P, where you're also looking at a higher number of indicators versus, for example, if you were going trend following, it'd be price space only. You're looking at, I think, 20 indicators, correct?
Right. What we did is we took 20 indicators that had been accepted in the academic world, that had been prominent in the academic literature. First, I should go back to there's this stigma about market timing, that you just can't time the market, and everyone should actually just be a buy and hold investor. There were a number of prominent people who believed this. There was Robert Merton said it was a fool's errand to try to predict the market. Paul Samuelson said it bordered on hubris to be so self-confident that you thought you could do this, and even Burton Malkiel, who wrote The Random Character of Stock Market Prices, said it's dangerous, you shouldn't do it. So there's the academics, and then throughout the investment community, there's this idea that the buy and hold is the way you should go. But in fact, in the last 20 years, we've had this explosion of data and this explosion of ways to analyze that data in terms of predictive analytics and machine learning that gives us a way of looking at this data in a different way. And so when this academic article that we wrote really goes through the academic literature, which has changed in that whole time too, where at one time people said you couldn't do it, and now the literature has really turned in favor of return predictability. There are very few papers now that say you can't do it. The majority of the papers do say, yes, you can actually predict equity returns.
You're pretty bold about the market timing and active management in the sense that maybe it's, for the last few decades, has received a bad moniker, but you have made the case pretty strongly that this is something you better pay attention to in the future, because the cards could come up quite different in the decades to come, so to speak.
That's right. I believe that people in the future, money managers will now be considered irresponsible if they do not look and consider market timing. And so I think it'll be a complete switch in the next 20 years.
Is there any similarity between what you're doing by bringing in the fundamental information and making it systematic? Your approach is all systematic, correct?
That's right. We have code. We have somebody that looks at the code every day, and it looks at the daily report, which is also available on the website, and where you can get an estimate of the equity risk premium each day. But that program is run every day. Somebody looks at it to make sure it's consistent and logical, but we go with what it says every day.
I thought one interesting aspect of the paper is that you talked about that you had significantly positive, above average performance, really nice performance in 02 and 08. And of course, in my world, I'm thinking, well, okay, I know some particular strategies that did very well in 02 and 08. What do you think is the reason, the economic reason behind what's taking place where your particular strategy in the S&P is doing so well and able to avoid those huge downdrafts that took place in those two instances?
There are a number of valuation variables, price to earnings, dividend yield, price to book value that are in there, and obviously we reached higher levels at that time, especially after the dot-com boom in 2000. And so the model said you ought to lighten up on equities, and it also has a trend following component. As people,
I saw the moving average in there.
Yes, there is we call it a moving average, but it's a sophisticated moving average that is highly correlated to most trend following strategies. So, when the market does turn down, that's one of the indicators. We do have a variety of other things in there, though. There's something called the variance risk premium. There's the Baltic Dry Index, which consistently is in the model. There's also another variable which we are very positive on, which is it's under CAY, and really it's consumption, wealth, and income. And the basic idea is that you should be able to predict on an aggregate basis for the nation what consumption is as a function of how much wealth we have and how much income we have. It ends up, if the economy is consuming more than what they should, that's good for stocks. If they're consuming less, it is bearish. And so that variable ends up being very prominent in the model. Now that was discovered by two academics in 2000. It's one of the significant variables. Now, the contribution of the paper is that how we combine these into a walk-forward simulation, and that we use information from a variety of sources that gives us these returns.
What was the motivation, Blair? This is a fairly extensive, it's one thing to sit down and say, okay, I'm going to code a trading system and I'm going to use one variable, for example, something like price. It's quite a different beast to put this type of system together, code this up. What was the impetus behind this? What was the thinking? How did you start to evolve this to get to where you are today?
Mainly, I believed in holding a passive portfolio of stocks. I'm generally a person that believed in the random character of stock market prices, and then I could not predict the equity return. And so I kept the same basic asset allocation, 60-40 or whatever it might be, although I obviously sold commodities and real estate in a diversified portfolio. But I was very disappointed with my returns in 2008. And I wanted to take my blackjack experience and my proprietary trading experience and develop a systematic way of dealing with it so that my emotions I wouldn't be caught up in the emotions of another 2008, that I could handle it objectively. And so I made a number of attempts at this, even before 2008, but at that point, I said, I need a systematic way of dealing with my exposure to equities. I'd always stayed close to the academic literature, and so I was attending a conference I know at the university in Chicago, the American Finance Association, and we talked. There was the Baltic Dry Index was one of those indicators that was in one of these articles, and then the variance risk premium, and the variance risk premium is it's actually VIX minus the realized volatility of the market at any time. If VIX is very high, then that's bullish only if it's high relative to what the realized volatility is. So I got all these variables, and I said, there has to be a way. And then I discovered one more variable in 2012, and I said, I'm going to put this through a walk-forward simulation. And that's when I started this project. It was done in Python originally. And it ends up that gathering the data is very costly. That's why I'm so transparent about what I'm doing, because I know how difficult it is. And I believe that people will try it, but they'll find it very difficult, and then they'll go to this product, the ETF that we have currently.
So it's either it's the S&P or cash. Those are your choices. Was there any thought early on, even though here you're trying to minimize the downside, maximize the upside of the S&P only, was there any thought that when you start to have, you mentioned 2008, was there any thought to this strategy being applicable to more markets, to having kind of like other opportunities, or you were just said, you know what, I want to tackle the S&P?
Well, we did think that we could go on to include bonds. So we'd have three assets. We'd have cash, bonds, and equities, and then we would move on to include other asset classes. And obviously, that's the optimal portfolio. But in this case, I'm having a hard enough time dealing with two assets. And so I wanted to solve the two-asset problem before I went on to these others.
Your risk control, the risk control that's embodied in this. This is... Talk some about that, this particular strategy.
We really base it on a 60-40 portfolio. We feel that on average, a 60-40 portfolio is a reasonable portfolio. And we're really trying to take a look at that portfolio. And then we're trying to be heavier in equities when the odds favor equity returns, and we're lighter when they don't. And we put some limits on that, and we actually, in this long-term model, we go 150% long, or we can go 50% short. And so there is some controls there, and we bet, and just as we do in blackjack, we bet in proportion to our advantage. If the count is counts +1, you bet 1 unit, and if the count's +2, you bet two units in blackjack and 3 units. And we do the same thing here. If we believe that if we think the equity risk premium is 0, we say we're going to hold it all in cash. And if the equity, and then we bet in proportion to that, so that on average we'd have a 60-40 portfolio, but we go back and forth between, we may go as long as 150% long and 50% short. On average, we hold less than 100% of the S&P 500. So this strategy will have a volatility that will be less than the S&P 500.
And if we're looking ahead, so we're talking about predictability. If we're looking ahead, this is not something where the strategy that you've put together, this is not a strategy where you're saying, oh, I know, it's predicting or it's got predictive value looking past 6 months. This is in the relatively short term to where the value is. And why don't you talk some also about your parameter estimates? This is a constant process that is, I guess the one way to say it is resetting itself every 20 days.
That's right. Originally, we ran the regressions, and it's actually a sophisticated type of regression. I've been talking lately about the advance in predictive analytics. There are all kinds of models out there that give you, but it's basically, all of these are basically regressions. So we started out doing them every day, and then we then went to doing them every 5 days, and then every 10 days, and every 20 days. And when we simulated the difference of updating the model every day versus every 20 days, it ends up not to be, there isn't a significant difference. And so we build a model every 20 days, then we trade for 20 days, then we build another model, then we trade for 20 days, and we keep going through and to figure out the best combination that will give us the best return on risk.
Is the ETF launched?
It launched about 6 days ago.
Perfect timing for our conversation, huh?
Yes.
I was chasing you a little bit, but I know it's a beast getting through the process and getting everything done that needs to take place.
It's not an easy process.
Yeah. Can I go back in time a little bit more, though? I'm curious, though, just some of your early beginnings, and I'm sure other people out there would be really just knowing some of that motivation. I mean, because, look, you don't have to be doing what you're doing right now. Okay. I mean.
Oh, yes.
So
well, I originally started, when I discovered this and I did this walk forward simulation, I said, wow, I can avoid 2008. My gosh, I want some other people to do that too. So I put it out on a website and allowed some friends to use it. But nobody's going to look at this thing every day. I didn't realize it. Oh my God, we all have jobs, we do all kinds of things, so we're not going to look at this report every day. But I did, so I had about 20 people that I gave the website to, and I saw that there were two really smart guys from New York that were looking at it every single day. And I didn't even really know them. They were friends of friends of friends. And I said, wow, I want to get this in the hands of people that can take advantage of this, because I really believed in it. And I thought, so it was really a little bit more of a benevolent activity than it was necessarily to make a lot of money. I wanted to have the security for my portfolio, but I wanted other people to have that security too.
Going back to your time in blackjack, it's once one has a winning method, sticking with it. I mean, we've kind of talked about that already, but how have you, beyond the simulations, you've been down this path at many points in your career, various times, but here you're launching this new trading vehicle. It's different. You've not done this particular one before, but there's not going to always be ups, right? So that confidence to stick with it, that building into your internal constitution, so to speak, that to stick with this winning method. How has there been anything different in terms of how you would go about that process today versus past opportunities in your life? Or is it just the same? You do the testing, you do all the walk forwards, you've done the simulations, this is good. I have now made the commitment. I will stick with this, period.
Well, I think you're really hitting on the key element here. Is can you have the discipline when you can go through losing streaks? How do you get through a losing streak and stick with a system? In this case, even in the simulation and back tests, all back tests are possible, aren't they? Well, if you look at this one, if you look at this paper carefully, in 2003, 2004, 2005, and 2006, it underperformed the S&P 500. And that's 4 straight years it underperformed. Now, overall, it gives you twice the return at half the risk. But am I going to be able to stick through the next 4 years of underperforming and then say this still works? And then that is the question. I mean, and that is the question for anyone. I think that fear and greed and emotions come in all the time. Am I going to be able to stick to this? That's a good question. I will tell you one of the things that I'm very fearful that I won't be able to do that. So one of the strategies I'm using is I'm developing shorter term models. I have a 1-day model that we've been using for quite some time here. It's possible that I will incorporate that into the ETF. And I do have some evidence that shows that there are other horizons out there. It seems like there's a 3-week horizon, words off Google Trends, if you can believe that. So the strategy, my strategy is to combine the 6-month, this is basically a 6-month model, with shorter-term models to give us the performance, will give us a little boost in performance that allow me to hang in there through what is inevitably going to be periods in which it's going to underperform.
That was just the word that I was going to mention again, which is underperform. It brings up the issue of benchmarks, which then brings up the issue of personal psychology. And why don't you talk about the hindrance or perhaps the handicap that benchmarks present? I mean, there's nothing particularly special about the buy and hold S&P trading system. I mean, it's just a trading system that buys and holds, but it's got this psychological grasp on so many of us and the investing population, but it's not a good thing necessarily.
If you can master this, if you can take a look at the available information and you can put it together in the appropriate way, you can develop a winning strategy. There's no question about that. And I go back to the academic literature, which I believe in, and everybody, all these papers are saying there is return predictability. Now, whether you can actually put it into a system and implement it is another question. And I think that this paper addresses that issues, and that's what we're trying to do. So I think we're in new ground here. It's going to be interesting to see how this works out in the next 10 years.
As we wind down, is there anything that I've missed today that you think is really important that we should be talking about with this particular strategy?
Well, in the end, it's going to be performance that will determine whether this is the winner. I would encourage you to stay and watch the performance, and also to look at the daily report that gives an estimate of the equity risk premium every day. I think that's at hullinvest.com. I think we're the only people that are doing that on a daily basis. So, no, it's been great to talk to you.
I appreciate you coming on.
My pleasure.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.